Hi, Zacharias. Good to see you. This is Viral. Hi.
Hi, Viral.
Hi. So let me just introduce Professor Sautner. Zacharias, as I know him, he's professor of finance at Frankfurt School of Finance and Management. Prior to that, he was at the University of Amsterdam, and even prior to that, he was at the Said Business School at the University of Oxford. Zacharias has published extensively in the areas of ESG, climate finance, and corporate governance, all of which are quite central to the theme of this conference. Uh, and he's published in some of the top journals of finance, such as Journal of Finance, Review of Financial Studies, Management Science, or Review of Finance. Uh, I uh, I I'm sort of relatively new to the whole climate change area. So when we were thinking that we need someone on the conference who's an expert on ESG, the first name that came to my mind was Zacharias, yours. And so I thought it'd be wonderful if you can upgrade our skills to all that you have done and others have done on ESG scores. So over to you, Zacharias, and we'll if it's okay with you, we can take some questions after your presentation.
Thank you very much for the invitation. Let me start sharing my slides. What I'm going to present today is some insights into the methodology and measurement surrounding ESG scores. And as you will see, I'll try to give a critical appraisal, and we'll try to raise lots of questions about the use and usefulness of these ESG scores. Here's the outline that I have for my talk. I want to highlight a little bit why ESG ratings have become so important. I will talk about the market for ESG ratings, about ESG ratings methodologies and challenges surrounding these methodologies. And then I'll dig deep into a series of papers that provide us evidence about comparability of ESG ratings and about conflicts of interest surrounding ESG ratings. And then I'll also try to provide you some insights in terms of alternative approaches to ESG ratings, more data, science-driven approaches, and I'll speak specifically about one of my papers where we give one example of how this could be done. Let me maybe make one introductory remark. So ESG ratings have become so important because whenever we think about ESG investing, we have to somehow measure ESG quality, right? So that's why, like Viral said, ESG ratings are really central to sustainable finance and this megatrend towards ESG investing. And as I'll try to lay out, there are trillions of dollars nowadays invested in part based on these ESG ratings. And so if you want to understand efficiency of capital allocation and also all these challenges we have surrounding the green transformation, we have to carefully think about what the ESG ratings can deliver and what they cannot. So the good, the bad, and the ugly surrounding ESG ratings. And that's basically what my talk will be about. Let me start by highlighting a little bit, also for those that are a bit further away from the topic, what ESG ratings are and why they have become so important. So just to make sure we're all on the same page, we talk about ESG investing, sometimes also called sustainable investing. And with E, S, and G, we basically mean environmental, social, and governance considerations taken into account when allocating resources, either through the equity or through the debt market. Traditionally, also if I think back about the history of ESG, we have basically started with governance topics and have a pretty good understanding nowadays for issues related to governance, such as compliance, board independence, compensation, shareholder proposal, shareholder democracy, and so on. And then only, within the last 10 years or so, ENS, environmental and social factors, have come into the game. And within the area of environmental, we basically focus on the big topic in there, which is climate change. So the Economist recently said we should replace environmental with emissions because that's the big elephant out there, and that's the primary focus that we should have. If you look into the industry, the other topic that has become pretty important within environmental topics is biodiversity. So I was recently at the PRI conference, and so there were lots of sessions surrounding biodiversity. So that's the climate change 2.0 in a sense within environmental within the environmental pillar. The social dimension is a little bit, less debated so far, but of course also very important. Also, if you think about India, and it's related to health and safety, for example, child labor and other considerations. Let me also say there is quite some evidence nowadays showing that if you want to do well on the ENS front, you first have to fix your governance side. Okay, so there's a clear interrelation across the three. So ESG investing is a very broad term, and we don't really have a good understanding and definition of what it's about. And that's also why there are lots of concerns about greenwashing, because there's no clear definition of what ESG investing is. And lots of investors now say they do ESG investing, but in fact, I would claim they don't. So what you see here is different investment strategies where ESG criteria are incorporated. And I have that picture here because across all of these investing strategies to measure ESG quality, usually ESG ratings are taken into account. So what you see here is basically the spectrum from more passive ways of incorporating ESG to more active ones on the top. So on the very passive side, you can do negative screening. So you can exclude certain sectors or certain companies. You can do norm-based screening. You can exclude certain investments that breach certain international norms or values. If you move a little bit further up, becomes a bit more active. So you can incorporate ESG, so sustainability themed investing to best in class investing. So you keep investing in all sectors. You're not including oil and gas, for example, or coal, but you choose the best firms in terms of ESG performance within a given sector. And then we have, broadly defined ESG integration, which is a catch-all factor of considering somehow ESG factors in the investment decision process. And that can be from, I quickly look at an ESG score and then basically forget about it, to having sophisticated valuation models that incorporate both in the cash flow estimation and discount factor estimation, the role of ESG and its impact on cash flows and risk. Then further up, you see there is, on the very active side, engagement and voting, which I'm a big fan of, and I have lots of papers showing that this can really have a major impact. So that's about actively engaging companies through behind the scenes engagement or voting to incorporate ESG criteria. And then top left, you have something that's called impact investing, which I would really exclude from ESG investing. I consider that a separate category. So ESG investing, I would say, is at the end about value creation, while impact investing, I would say, is more about values, less about value, more about values. So investors that do impact investing are willing to give up some return in order to get a societal or environmental impact. And I would say that impact investing is maybe 1% of the whole sustainable finance space, while the ESG type of investing that I just defined is 99% of the equation. So here is a number that is really impressive. So you have probably heard about the Principles of Responsible Investing. It's an initially UN, United Nations-based initiative where institutional investors can become signatories and then commit to incorporating ESG principles in the investment process. And what you see here is the explosion in assets under management of signatories that were subscribing to the PRI. So we're about at 140 trillion US dollar in terms of assets, where the investors that are managing these assets have kind of committed to incorporating ESG criteria in the investment process. And why do I have that picture here? Well, because most of these investors are relying on ESG ratings in order to fulfill the commitment that they went into by signing up to the UN PRI. Why is that? Well, because as I just said, if you become a signatory, you subscribe to a set of principles that you have to follow when making investments. And I just have here one, highlighted principle, which is principle 1. So if you are a signatory, and all the major investors basically are signatories nowadays, you say, we will incorporate ESG issues into investment analysis and decision making. And as I argue, for most of these investors, I would say 90% of the stocks in the portfolio are incorporating, ESG investors are incorporated by basically taking into account ESG ratings and not forming their own perspectives on these ESG issues. Here's a fascinating study by Horstman and Sussman in the journal Finance that shows all of us how influential ESG ratings have become. It's a study that does the following. So you have maybe heard about Morningstar. Morningstar for a long time has evaluated the financial performance of mutual funds by giving stars from 1 star to the low performing funds to 5 star of the high performing funds. And they've started to do the same in terms of ESG sustainability performance. So they take a mutual fund, look at the stocks in a mutual fund, look at the ESG ratings. Here you see why ESG ratings are important for this, of the stocks in the mutual fund portfolios. And these mutual fund portfolio ESG ratings are based on Sustainalytics, because Sustainalytics is part of Morningstar. So they look at the stocks in the portfolio, look at the Sustainalytics ratings of these stocks, and then aggregate the ratings up to the portfolio level at the mutual fund. And then categorize also here mutual funds into the top 10%, which are those stocks that have the best ESG performance, the best ratings, and then down to the bottom 10%, the portfolios that have the lowest ESG quality based on these ratings. And then they give globes, from 1 globe, poor ESG performance, to 5 globes, high ESG performance. Now, what is really impressive with this study is that the study exploits that Morningstar started to publish these globes that evaluate the ESG performance only in 2016. So from 2016 onwards, these globes are available, so investors that can make investment decisions have this ESG rating based information available when making investments. And what you see here is that the study documents strong inflows into the 5-star funds, in the high sustainability funds, and strong outflows out of the low sustainability funds. What that means for you as an investor is that as a mutual fund manager, is that those people that give you the money seem to take into account these labels, these rating-based assessments. So therefore, also you have an incentive, of course, in order that when making investments, to improve the globes that you got by taking into account the ESG ratings of Sustainalytics when making investment decisions. Note that before 2016, when the ratings of Sustainalytics have been available to the market, but were not so salient because the globes were not there yet, there was basically no role of these ratings, right? Investors could have collected the information by themselves and taken into account, but apparently they didn't, right? So the fact that these globes were made available had a big, salience effect and impacted in a strong way mutual fund flows. Okay, so the study shows that for investors, these ESG ratings are really important because they eventually influence the fund flows that they themselves get from the final beneficiaries or investors in the funds. Also for companies, these ratings have become extremely important, of course, because the question whether a mutual fund invests in you or not, based on the previous study, does depend on how your ESG rating, specifically the one from Sustainalytics, looks like. So here's an example from the webpage of Novartis, and they list all the different firms, ESG raters that rate them, how they score in absolute and relative terms, and provide also some explanations of why the scores are as they are. Okay, so companies really care about the ratings they get because, as I just showed, these ratings affect whether they get money from mutual funds, and that, of course, then determine cost of capital and other things. I'll speak more about the specific raters in a little bit. Now, there's another reason why these ratings have become important, and here's an example from Germany, from a company that is just outside of Frankfurt. This company has issued a bond recently, a sustainability-linked bond, arranged by ING. The company is called Norma Group. And what's really interesting, this is a wider trend that extends beyond this specific example, is that the interest rate on the bond, on the loan, is a function of the Sustainalytics rating of that company. Specifically, the interest rate that has to be paid on the loan is a function of the ESG rating by Sustainalytics. So if the company improves its ESG performance, and that is reflected in a better ESG rating by Sustainalytics, then the interest rate is also going down. And that's a broader trend that we see in the market, that more and more sustainability-linked bonds are issued where the margin, where the interest rate is a function of ESG performance and often measured based on ESG ratings. So also here you see these ratings have really become critical for the cost of capital and financing of companies. So that's why it's important, given that that role that these ratings play, to understand this market for ESG ratings and the incentive structure that these raters have. So here's an overview of some of the key players in that market. And I already talked about Sustainalytics, which is part of Morningstar. You probably know MSCI, which bought KLD, ESG rater, and now also has a rating franchise. And there's also ISS, that you probably also know, which is nowadays part of Deutsche Börse and also provides ESG ratings. These three raters, and I have the details in a little bit, these three raters are responsible for about 60% of the market share in ESG ratings. But there are also other providers. What you see is that there are also rating providers that are part of the credit rating companies, Moody's and S&P. That's something I'll get back to in a moment when I later talk about conflicts of interest and empirical evidence that these conflicts of interest seem to really matter. I'll also speak later about the Refinitiv, because I have a study myself that looks at Refinitiv and the ratings provided by that company. So also for investors that use Bloomberg terminals on a day-to-day basis, these ratings have really become very salient. So on the Bloomberg screen, there's a specific screen, and here you see as an example BP that reports for different rating providers, here for Robeco, Sustainalytics, Bloomberg, ISS, and CDP, the performance of that company, and then also looks into ES and G subpillars and performance along the ES and G dimension. So a bit more about the market for ESG rating. So the market for ESG rating is more than $1 billion in terms of the money that investors are paying to the ESG raters. And that's important to understand. It's the investors that are using the data that are paying the raters. Different from the market for credit ratings, where it's not the investors using the data that are paying, but it's the issuers that are getting rated that are paying. So this is a different market. So the market size is more than $1 billion, and the largest chunk comes from what's labeled here as ESG research and analytics, which is ESG ratings. And then the remaining part from the indices that some of these ESG raters are also providing, and then others are using for benchmarking purposes. Here's the number that I just told you. So there are three MSCI, ISS, and Sustainalytics that are the kind of big three in this market and have a market share of about 60%. And then there are lots of smaller players. And one of the smaller player is Refinitiv, as I said, part of London Stock Exchange nowadays, and I'll look into a little bit more detail. That's why it's highlighted here for that specific one in my own study. But I'll also speak about Moody's and S&P, as there's a study that looks at ratings of these providers. So what you see here is a survey by raters among investors, and one of the question was, how regularly do investors use these ESG ratings? And you see very regularly. Right? Very regularly are investors using these ratings. And that's really because if you think about a big investor that has thousands of stocks in the portfolio, you will not be able to build up the internal resources to form an ESG perspective about the ESG quality of every single portfolio company. You may do that for maybe the largest, the most important ones, the key players from your own country, but you will not do that for 95% of the other stocks in your portfolio. So there you rely usually on ESG ratings. They also ask, what source are you using for evaluating ESG performance or ESG quality? And, consistent with what I just told you, the number one answer is that to assess ESG quality, we use ESG ratings. Why are investors using ESG ratings? Well, the number one answer is to provide information or get data that is material to investment performance, and also to supplement the internal research that they have been doing. What's also important is that the number three answer is that we're incorporating ESG ratings because there is a growing demand by other stakeholders to use ESG ratings. And that's something that I've also found in my own research, right? Specifically on the climate finance topic. It seems that a lot of investors are incorporating ESG, not because they think it creates value. I do think it does, but not because they think it's incorporating value, but it's basically to cover your ass. Because of reputational concerns and because they think their final stakeholders care about it, so they should take it into account. So let me talk a little bit more about ESG rating methodology and challenges surrounding this methodology. So in a sense, ESG ratings are a combination of raw data related to E, S, and G criteria. And then there's some weighting of this raw data along the E, S, and G line to aggregate it up into an overall rating. Right? And think about my first picture that classified E, S, and G in all the different subcategories. So a rater would look at all these different categories and weight them and then aggregate it up. Now, the exact methodology, the exact combination is often a black box. There's no transparency about that as of now, partially because, of course, that's a proprietary business model of these raters. What's also important to understand is that there is some product differentiation. The raters want to get market share. They want to be different from the others. So there are differences in terms of rating cycle. So some firms have a rating that is updated on a daily basis. Others have more quarterly frequency to update rating. There's a difference between some raters that are more kind of event-driven, especially rep risk, versus others that are more fundamentally driven, kind of bottom-up, looking at the firm fundamentals to create the rating. There are some raters that are more analyst-driven, where there are individual analysts assigned to companies that are collecting the data, hard and soft data from the companies, whereas others that are more data-driven, machine learning-based. And then there is also quite some differentiation in terms of what stocks are covered, in terms of the universe of firms that are rated. Usually, the ratings are relative ratings. Remember, one of the investment strategy was best in class. So that's why for doing best in class, you want to know how a firm performs relative to its peers. Now, what's also important to remember is that most ratings are backward-looking rather than forward-looking, and that's a complaint that lots of investors have, right? They say it's not overly helpful to have reported carbon emissions. What we care about is the path that firms have in terms of reducing carbon emissions moving forward, and whether these plans are Paris aligned or not, when net zero is achieved, and how credible that is, and whether the capex plans of the company are aligned with these net zero plans. That's usually not incorporated in these ESG ratings. But if you think about what finance is about, it's all about future cash flows, right? So, we should also have ratings that are forward-looking and make assessments of future cash flows rather than be backward-looking. Here's an example from Refinitiv about the specific rating construction. You see here within the ESG score, they look at E, S, and G, and you see some of the category scores that they generate. And what you see below that is that they're basically calculating 450 plus ESG metrics, have 186 comparable measures that are used in order to come up with measures across these different categories. And just to give an example, when they look at the social score, they look at factors related to how the firm deals with the workforce, with human rights, with the community, and product responsibility. Apart from the ESG rating, they also have a controversy score, right, which is less fundamentals-based, but more events-based. If there are specific ESG-related controversies, they try to take that into account. And then you can also buy their combined score, which combines the kind of more fundamental-driven ESG score and the more event-driven controversy score. Now, the raters also tells us that there's quite some variation in terms of ESG rating quality as perceived by the market, right? And I don't want to go into detail, but you see here that the investors that use these ratings believe, for example, that the quality of the ratings by CDP is very high, while that of Vichy or IRIS is very low, right? So based on the surveys, there seems to be quite some variation in how the quality is assessed. Rate the Raters also asked investors, what factors do you think determine the quality of ESG ratings? And you see some of the responses here. It's about quality of the methodology. It's about disclosure of the methodology, usually quite poor. It's about whether they focus on relevant material issues or not, and how credible the data sources are. Very important also seems to be the experience and competence of the research teams that are providing these ratings. So if you think about the challenges that we face when it comes to ESG ratings, you can think of challenges related to the providers of the ratings and the users of the ratings. So let me highlight some of the key challenges that we face here. The first key challenge is, how reliable are these ratings? Reliability may be poor because there are data errors. Data errors may arise from the raters' data, but also from the corporate data that is published and then used by the raters. There are concerns about the reliability because of limited experience of the research teams, because of unreliability in the estimation procedures, and also concerns because, as I mentioned earlier, often these ratings are not forward but backward looking. Another challenge is the transparency of these approaches that are often black box. Right? And that resembles a debate we had many years ago after the financial crisis, where the same claim was made about the credit ratings, and later we had all kinds of procedures and regulation to increase the transparency. Right? So my prediction is we will see the same also moving forward for ESG ratings. Now, there are two other concerns that I'll discuss in much more detail later on. There are concerns about whether these ratings across raters are really comparable, and there's evidence that they are not, and we'll see why. And there are also concerns, and that's really critical, related to conflicts of interest. Why is that critical? Well, because as I've shown you, a lot of the resources nowadays in financial markets are invested based on these ESG ratings. And if there are conflicts of interest, and therefore ratings being affected by them, we may see large misallocations of resources. There are also concerns that are related more to the ESG rating users. A big concern is what I label here hiding behind ratings, cover your ass, right? That ESG raters are not basically ESG rating users are not really coming up with their own perspectives on the ESG quality of a firm, but blindly rely on ESG ratings to cover their asses, so that if someone later comes and says, why did you invest in that firm that turned out to have a very poor ESG performance ex post, they can say, well, we relied on the rater. In general, also, there's, in my view, too much focus on the overall ESG scores and too little use of the raw data or the sub-scores that are underlying the scores. And that's, I think, because it requires much more resources among the investors to really use and understand the raw data, rather than to just simply, put into your model or portfolio tools an overall ESG score. Now, these concerns are in part also mirrored in kind of comments that we have from users of the rating companies. So this is just some comments that I've collected from Rate the Raters, where investors that are using the data, for example, say you can have Sustainalytics, MSCI, and CDP with different carbon emissions numbers for the same company. Okay, something that seems easy to observe and measure differs across different raters. Then others are saying, well, they're all rear view mirrors. They only tell you something about the past. Again, they're not forward-looking. Some say these ESG ratings are often just checkbox exercises, maybe using AHR, which lead to low quality. And they also say ESG ratings are often poor because the people that are rating these companies have little experience, and we in-house have much better experience because we've been doing that for much longer time. Right? So big challenge in terms of human capital quality are raised here when it comes to the ESG ratings. So I'll now dig deeper into these two studies with some evidence on comparability and conflicts of interest. So this is a study by my co-author, Florian Berg from MIT. And what he did is, he basically looked at different raters, Asset4, KLD, Robeco SAM, Sustainalytics with Geo Iris, and calculated to what extent they agree on the rating of a given company that they all rate. And what you see here are correlations across the raters. And from just eyeballing the numbers here, you see the correlations are on average just about something like 60%. That compares with correlations of above 95% when you look at credit ratings and the assessment by S&P, Moody's, and especially S&P and Moody's, right? So very little agreement in comparison to the credit rating market. And you see there's a bit of variation here also across the ES and G dimension. To understand why this is the case, let me just give you an example from Tesla. Okay, so you see here Tesla, and you see if you look in the environmental score, the assessment by FTSE, ESG rating by FTSE and MSCI, as well as Sustainalytics. And as you can see here, MSCI says they're a super green company, Tesla, because they have electromobility. While FTSE, on the other hand, says it's a very brown company, it's a very dirty company, because there's so much water involved in producing these batteries that they cannot have a good ESG quality, or here specifically E quality. Right? So you see there's a lot of disagreement in measuring E. You also see, if you look across E, S, and G, there's a lot of disagreement in terms of E versus S versus G. Right? So a firm could do well on the E dimension, but poorly on the S and the G dimension. So where does the disagreement come from based on the study by Florian Berg and his co-authors, Kolbe and Rigobon? Well, there can be differences in terms of that arise because of differences in terms of scope. Right? One rater may include corporate lobbying or net zero target when coming up with the ESG rating, while the other not. It can come from differences in measurement. One rater may assess employee labor practices based on employee turnover, the other based on labor court cases, right? We may measure the same thing differently, or they can come from differences in weightings. So different raters may put different weights on the same items. Carbon emissions, you put 20% of weight on it, I only 1%. And that may also lead to differences in the overall ratings and the agreement across rating. You see, scope is responsible for about 38% of the differences, measurement 56%, and weightings about 6%. So more on now conflicts of interest. So let me just start and highlight again with pointing out that a key difference in the business model between credit ratings and ESG ratings is that in the credit rating space, the issuers are paying, while in the ESG space, the investors are paying for the ratings. Okay. What's also important to remember for what I will show you later and for the discussion more generally is that the raters have additional businesses, consulting businesses, broadly speaking, and are not just creating ratings. For example, a lot of the raters provide second-party opinions, so they assess on behalf of the investors the debt instruments that are related, for example, that are green bonds or SDG, sustainability-linked bonds, so that then investors can make investments into these products. They also, at least some of them, are providing ESG consulting services to companies. They go to companies that they rate and also sell them consulting services on how to improve ESG performance. Some of them, and that will be critical later on, also provide credit ratings. So they assess companies in terms of ESG dimension, but they also have a business model with them because they are issuing bonds and therefore get paid by these companies through the credit rating franchise. And then some also do index business, for example, MSCI, which can also lead to potential conflicts of interest. I'll not speak about that today, but it's also something to keep in mind. It's not just me raising, red flags about conflicts of interest. There's a letter by the chair of the European Securities Market Authority to the European Commission, and he says that I would like to address the unregulated and unsupervised nature of the market for ESG ratings. He says, I have concerns around the protection against conflicts of interest that may arise in the business models of these rating providers. As a result, there's a risk of capital misallocation, product mis-selling, and greenwashing. Right? Exactly like what I also have been highlighting. So I'll speak briefly about 3 studies. The first one is a study that I have with Florian Berg and Cornelia Fabisek, and I'll speak in a little bit more detail about this study. So basically what we do in this study is we look at the ESG ratings of Refinitiv, and we demonstrate first that there is a retroactive rewriting of the historical ESG ratings of Refinitiv. So we show widespread changes to historical ratings provided by Refinitiv. And we show that ESG-based classifications of firms change depending on when you downloaded the data. Right? So depending on what vintage of the data you use, the rating of, let's say, Tata in 2010 is different depending on whether you downloaded the data in 2019 or 2020. Okay? And that's important, as I'll show you later, because if you're an investor, for example, that wants to backtest an investment strategy, you really need to make sure that you had the data available at the time of forming your portfolio, rather than a rewritten data that was rewritten just a day ago. Second, we provide insights into the incentives of the ESG providers as of the evidence we have now. And we'll also challenge ourselves frequently, and you'll see why in a moment, whether there are other explanations of what we find in the data. So more concretely, we show there's a positive link between ESG scores and firm stock returns in the rewritten data, but not in the initial data. And our argument as of now, because we haven't found better explanations, is that the rewriting is consistent. It's not proof yet, but it's consistent with an incentive channel whereby the rater rewrites the data so as to introduce this link between returns and ESG scores, because that makes it easier then to sell the data, because as I'll show you, investors that use the data and pay for it, they care about the ratings being helpful for predicting stock returns. Refinitiv is very important, not just for investors, but also, and in particular, for academics. There are more than 1,500 papers in the literature that have used these ESG ratings by Refinitiv, formerly called Asset 4. Maybe you have seen and heard about that name. So why does it matter whether ESG ratings are rewritten or not? Right, and you may be familiar with that for other time series, like macro time series and so on. In the private equity space, there's also literature on that. Well, because it affects ESG investment strategies. If you're unaware of these changes, you as an asset manager may erroneously benchmark yourself against the rewritten data that was unavailable at time of portfolio construction. That is what we call look-ahead bias. Right, so it's really important that one becomes aware of this, that this data has been rewritten, so that moving forward, researchers and investment professionals carefully check and verify the data integrity, and especially the data version that they need to perform the tests. Can you use the rewritten data, or should you instead have the original data that was available at the point in time when you made the investment decision? How do we show this? Well, we show this first around a major methodology change that was announced by Refinitiv. So it was not, covered under the rug. So they talked about this. And we show this by looking at the same set of firm years covering the years 2011 to 2017 that we have downloaded in September 18 and again in September 2020. And in between was the methodology change. So we compare the same set of firm years across two vintages of the data, and we find the very significant rewritings of the data. But we also show that this methodology change related rewriting of the data is not a one-time event. We also show that Refinitiv continues to adjust the data ex post on an unannounced basis. And we show this by looking at additional data from February and March 2021, where there's a continuous rewriting of the data. And we're currently updating the data. We have also looked at all other raters. It was a huge financial investment to get all the other raters. And let me just preview that basically we find this only for one other rating provider so far. And I don't want to say too much because we're still checking, but that seems to be also a smaller rating provider. And we argue that this isn't a coincidence, because we argue that this incentive to do this is particularly strong because there's also a downside for the smaller players that have big incentives to take risks by doing this and increase market share. So the ESG ratings by Refinitiv are on a scale from 0 to 100. Like I showed you earlier, it's along the ESG dimension, and they have different subscores. And here's an example that illustrates what's going on. And it's an extreme example, but it's an example. So you see here in blue, the download from September 18. In light blue, the download from September 2020. So this is around the methodology change. And then another download where there was no methodology change, but there's a continuous rewriting going on that we argue is unannounced. Right? So you take that company, it's the same set of firm years, right? It's all downloads much later than 2017. And you see that the historical data has been significantly rewritten by a refinitiv in the database. So depending on when you download the data, you have very different views on the ESG quality of the company. It really matters. For example, just to illustrate that, if you want to quantify what's the top 10 firms in terms of ESG performance, which you often do in research, right? You want to look at, a portfolio that goes long in the top 10% firms and short in the bottom 10%, or in, corporate finance regressions, you want to see whether firms that are in the top 10 perform better during COVID versus the others and so on. But how you classify firms really depends on the vintage you use. So if we look at the two vintages of data around the methodology change, only 70% of the firm years would be classified in both downloads of the data as being in the top 10. Top 10%. The other 30% of firms would be classified in either, but not both data sets. And it gets even stronger if you just look at the ENS scores. Right here, the overlap in terms of what's a top 10% firm is only 57% if you look at ENS. Right? And again, if you set up a portfolio and you do a backtesting strategy, that really matters. If you run corporate finance or asset pricing type of analysis for research, it also really matters. Right? So you will get different results running the same specification depending on when you downloaded the data. Yeah, and we also show this concretely in our paper. So here in the first column, you see the download before the methodology change. The next one, you see it after the methodology change. And you see that before the methodology change, there's no link between ESG ratings and future returns, next year returns. But in the rewritten data, there is such a positive link. So the data is rewritten in such a way that a positive link between ESG scores, here the ENS score, there we have stronger results, and the future returns are introduced. And we explain in the detail in the paper, lots of detail, that there's no reasonable argument why the methodology change should introduce that. So we believe it's a systematic pattern that, so we believe as of now, is because the market that buys the data has a preference for data that is useful in terms of predicting returns. Right? And you also get this result if you look at the top 25% performance in terms of ESG quality. And we also see that, at least for the top 25%, there is through the ongoing rewriting, a further strengthening in the result. Again, let me stress, we don't have proof yet, okay? So this is our evidence, and in the paper and also through the revision, we are checking all kinds of different alternative channels, and so far none of them was such that we could rule out this current running hypothesis. So why do they have an incentive to do this? Well, because the evidence shows, based on this Rate the Rater surveys, that investors that buy and pay for the data, they care about a useful linkage of ESG ratings to company financial performance. Right? It's a consideration they have, and it seems to suggest that it's easier to sell data if there is such a link between ratings and financial performance. Just as a side note, conceptually, it's not actually clear at all why there should be a positive link between ESG quality and returns. Conceptually, you may actually expect the opposite. If ESG stocks are less risky, returns should be lower, but that's not how the financial sector usually thinks about ESG returns. So the rewriting we show in the paper originates mostly from how the raw data is aggregated, not from raw data changes. So it's more the black box part of the ESG rating that seems to create this link between returns and ratings, which we believe is consistent with our journal, because arguing that the raw data changes is much more difficult because it's easier to observe and verify. We show results are not explained by newly uncovered negative ESG events in the past. It's not caused by a conversion towards other raters. We also now show it's not yet in the paper, that it's not reflecting a reduction in measurement error, that they're getting closer to the truth. We still have to consider other channels, whether there's a change in the rating universe that causes that. First evidence suggests that no, right? Because ratings are relative. So if in different vintages you have a different universe, that may also cause ratings to change. but we show that doesn't seem to cause the result. And we are also currently checking whether some of the results are caused by investor the rater learning from ESG funds, and the ESG funds maybe buying stocks and creating a positive return that in their view had good ESG performance, and that wasn't seen by the rater, and therefore the ratings are changed to reflect that. But we don't have evidence yet on this, which we're still checking with. So now, let me just say that a couple of months after we uploaded this paper, Refinitiv went out and sold a new product to its customers called point-in-time data, the old vintages of the data. And the funny part is, if you look at the explanation why they do this, then the global sales director says it's because these statistics demonstrate, the new data demonstrates how standard data sets, what they have been selling all the time, can create biases and inaccuracies in back tests and machine learning models, and why quants and data scientists should instead use the point-in-time data. All right, so here you go. They have recognized themselves that what they've been selling and been doing seems to create problems. We were lucky to get a broad media coverage already in the sustainable finance industry, and there's been a big article in the Responsible Investor. And we are happy with this because at the end we want with our paper that people become aware of this data rewriting and are careful when thinking about what data to use, and also how these things link, of course, to returns, because that's at the core of ESG investing. Let me talk about two other studies and just check how I'm doing on time. Looks good. So the other study now looks at different potential conflicts of interest. The first study by Tang Yan and Yao looks at common ownership. It's a fascinating study. So what they do is they demonstrate that companies owned by the same institutional investor as the ESG rater receive higher ESG ratings. Okay, so you have an ESG rater, it's MSCI in the study. You have other companies that are rated by MSCI. So if they have a common owner, then the ratings of that sister firm are better. And they identify this common owner effect of the ESG ratings primarily from exogenous changes in the rating ownership, which occurred because MSCI bought the rating provider KLD. And so therefore, there's a change in ownership that starts to introduce this common ownership, and they're exploiting this to document this effect. There's some evidence in the paper that these inflated ratings are problematic because they show that these so-called sister firms have worse ESG performance, more negative ESG news after the ratings, and therefore seem to be, compared to kind of benchmark firms and peer firms, having a lower quality that is not correctly reflected in these inflated ratings. This is the evidence. So the dependent variable is the ESG rating. And in their sample, they have these so-called sister firms that are commonly owned, right? Where there's an investor that owns the rater as well as these companies. And of course, then this common owner, they argue, has an incentive for the rating being nicer because they benefit from the rating being nicer. And so you see that for these sister firms that are commonly owned, the ESG ratings are better compared to other firms that are not having this common owner. And they also look at kind of pseudo sisters that are kind of providing, a benchmark, and find no evidence for these pseudo sisters, for which there's no common ownership introduced because of this transaction, the takeover of KLD. Here's the evidence that indicates that these ratings of the sister firms are inflated, reflecting on conflicts of interest, because here's a table that tries to explain negative ESG incidents of these companies and compares it across sister and non-sister firms, so commonly owned firms with the others. And remember, these sister firms have these inflated ratings, and that's problematic, right? They seem to have a good ESG performance, but at the same time have much more negative ESG incidents moving forward, being indicative of the ratings being too high. Right? If the ratings would be correct, you should not expect a difference in the ESG incidents between the sister firms and the non-sister firms. They should just have, similar amounts of ESG incidents, but that doesn't seem to be the case. The last study is looking at conflicts of interest arising from two ESG raters being part of a company or companies that also provide credit ratings, Moody's and S&P. So what this study by Lilo and Zhang shows is that after the acquisition of Vigeo Eiris and Robeco Sam, ESG raters, by Moody's and S&P, the ESG rating agencies issued higher ratings to existing paying clients of Moody's and S&P relative to other firms where there were no such commercial ties. And they show that this effect is greater for firms that have more intensive business relationships. Right? So here, these are firms that are rated, and these firms are also paying the rater indirectly because they're issuing bonds and therefore get a rating from Moody's and S&P for which they have to pay Moody's and S&P. There's also some evidence that the upwardly biased ESG ratings help Moody's and S&P maintain credit rating business, being also indicative of such a conflict of interest. And here's the main table that shows this. So they're looking at Moody's and S&P's ratings and the difference relative to a benchmark here, Refinitiv. And you see that after post the acquisition of the rater by Moody's and S&P, the ratings are going up, right? If a rated firm is a paying client of Moody's and S&P's credit rating business. Right, and they show, there's some variation. For example, the effect is stronger among firms that do a lot of credit rating business with S&P, where there's more money basically being paid to the overall company from the rated company. Yeah, and they have some more evidence, as I just said, that indicates that these inflated, upgraded ratings also seem to lead to future business, and you see that here with respect to Moody's or S&P. The last point of my presentation is about alternative approaches, and it's specifically the paper that I have, where we introduce a method that identifies ESG performance, specifically in our paper, climate change exposure, from earnings calls. Right. So what we do is we have a paper that basically automatically reads through transcripts of earnings calls where management and analysts come together and tries to then assess the ESG performance here, firm level climate change exposure, based on the discussions in these conference calls and the extent to which ESG, climate topics are being discussed. Now, the nice feature is that you can automate that and you can make that widely available, and we do. We've made it widely available for other researchers to use it. We have rated more than 10,000 firms along this dimension from many, many countries. We regularly update it, and everyone that wants to use the rating can use it and doesn't have to pay thousands of dollars for the rating. We, in the paper, validate carefully that the rating that we have, the credit rate, the climate change exposure makes sense. What we also do is we're not just assessing to what extent a firm is exposed to climate change, but specifically whether it's exposed to opportunities related to climate change and or physical or regulatory risks. Whether there's lots of discussion on physical risks or regulatory risks in these calls, or more discussion of opportunities. We also, in the paper, create measures that combine with that the sentiment of the discussion and whether there's a discussion about risks primarily. So it's a very rich methodology. I don't think I want to go into the details, given that the time is running out, of how we do this, but basically it's a machine learning algorithm that first learns what are discussions about climate change, because you cannot just throw into the machine learning into the algorithm a set of keywords, because it's very hard to think of keywords that are being discussed by analysts with management when it comes to climate change. It's very specific terms, right? So we have we build on a machine learning mechanism that first learns what are discussions about climate change. And then here you get a bit of a feeling of how that looks like, right? We classify, for example, industries based on these measures, so firms and industries, and then aggregate it up into industries. So maybe let's highlight that here. So we find based on the measure that the firms or the sector that has the biggest exposure to regulatory climate risk is utilities, coal mining, petroleum refining, oil and gas makes a lot of sense. Also identify those firms that are most or industries that are most exposed to physical risk. You see some of the examples here. Now, the measures are useful. What we show in the paper is that these measures predict green tech job hiring. We show that it predicts green patterns. And we also show that the measures seem to be priced in financial markets when we look at option markets, for example, or stock returns. That's all I have to say. So it was a tour de force, if you want, across everything I consider important when we have to think of our credit ratings. I think the key takeaway is that we really need to think carefully about the incentives of that industry and challenge them and challenge the industry, because there's so much money tied nowadays to ESG ratings that we want to avoid capital misallocation. Therefore, we as you as regulators, we as academics have to challenge that industry to achieve positive outcomes when it comes to the green transformation. Thank you. I'm happy to take questions.
Hi, Zacharias. My name is Suya Gidigunta, and my question is on the chart where you showed passive to active investing. In the chart where you talked about passive investing to active investing. If you look at the data of India, right, who owns the Indian companies? Nearly 50% is owned by the promoters. So all the mutual funds, HNIs, and retail investors are all minority shareholders. They are not the controlling shareholders. So how can a non-controlling shareholder can influence in the ESG decision making? Which is because you don't control. So do you need the support of regulator or somebody to kind of able to influence as a minority shareholder over a controlling shareholder? Thank you.
Okay, so I didn't understand everything, but I think the key part of your question was how can non-controlling shareholders influence ESG performance, right? I think that's a very, very important question. So there are different ways. Of course, we know, for example, from the literature on hedge fund activism, that also small investors that have 5% or 6% can have a big impact on the governance, for example, performance of companies. So that's from the hedge fund literature. So if you manage to coordinate with other investors, then this is clearly something that you can achieve. Now, second, I actually have a study where we look at one big investor, Hermes, now part of Federated Hermes, and where we also show that this investor that doesn't have a controlling stake, but does engage and has technology to engage well, seems to generate positive ESG outcomes. Specifically, it seems to be able to reduce ESG-related risks. And we show this that based on kind of documenting that after the engagement by that investor, measures of downside risk are declining. All right, so that's the second response. Now, the third response, in terms of the really big picture, is that what investors have done is recognizing that they have small stakes, but also that in order to overcome that challenge that comes with it, they have formed coalitions. So they have formed coalitions, for example, so Climate Action 100 Plus. So Climate Action 100 Plus is really a very important initiative where different institutional investors with trillions of assets under management have come together and said or recognize that carbon emissions are extremely skewed. So there is about 180 firms responsible for about 70 or 80% of global industrial carbon emissions. So if we get these firms to reduce their emissions, we get a lot of mileage. So these investors have come together on this platform, Climate Action 100 Plus, and they have identified lead investors that are engaging the companies on behalf of the others. Right? So a lead investor would go and say, I have 3%, but I speak on behalf of investors owning 40%, and I want you to do X, Y, and Z to reduce your emissions and improve your carbon-related disclosures. Right? And that's an important channel that is being used. Now, having said this, now we have lots of also regulators in the room. A key challenge seems to be on the legal side that a lot of investors are concerned about acting in concert when speaking with other investors about these engagements. And I think it's time for regulators to rethink, in many countries very strict, acting in concert rules, and how to relieve the constraints that a lot of investors are facing when it comes to coordinating with others in order to engage on ESG topics, and especially in climate topics. Okay, there's a big concern about acting in concert.
Yeah, thank you. I think, one of the key aspects, as you said, consort of investors coming together and at the same time help with the regulator will help us to overcome this problem. Thank you.
Thank you, Sautner, for the wonderful presentation. My question is related to the ESG rating, especially the ESG materiality risk. So different industry have the different ESG materiality. So in terms of the methodology in ESG rating, how this materiality has been addressed, especially for example, software industry have the less emissions, GHG emission as compared to the manufacturing industry. So how this materiality of ESG factor has been factored into the ESG ratings?
So these are great points. So let me make a few observations. First, you're absolutely right. The cement industry faces a huge challenge, and it will take some time until they have all the innovation in place in terms of green cement and so on. But of course, we also need this industry. And so that's why I think it's very important that we continue providing funding also to the kind of brown sectors, because we want the brown sectors to have resources to innovate. So if we fully agree that we should divest from all these sectors that are problematic, we will not manage to get funding to these sectors that they need to become greener. And we all agree we will need cement moving forward. Right? So that's why I'm very skeptical when it comes to divestment strategies. Right? Because broadly speaking, you can think of two strategies to address ESG issues: divestment versus engagement. So I'm concerned about divestment because they may lead, or also on the debt side, not giving debt, they may lead to these firms not having the resources that they need in order to innovate and become greener. But through engagement, you can achieve this. You stay invested, you keep providing funding, but you go into an active dialogue with the companies, and through voting, through other means of shareholder proposals and so on, and incentives, linking compensation to CO2 outputs and so on, you try to positively influence these firms so that they make the green transition. Now, the second point is also important when we look at returns of ESG strategies. There is quite some evidence historically, right, that ESG funds did outperform, but that's largely driven because a lot of the ESG funds are very heavily loaded and invested in the tech stocks that did quite well. I know the last 6 months are different, so there will be lots of surprises. But if you look at the longer picture, there's there are lots of ESG funds that did well, not particularly because of any ESG related strategies, but just because these tech firms had good ESG ratings because they don't produce a lot of emissions, for example. And they did well for quite some while. And that's why also, as I mentioned earlier, we have to really be careful what is really ESG performance, and how should it link to returns, because it's unlikely that we're going to see that moving forward. And in fact, maybe already if we look at the last 6 months or so.
I am RSP Singh. I have two queries. First is, I just wanted the confirmation. You mentioned that it is unregulated market, ESG rating. So I just wanted to confirm whether it is globally unregulated or it is unregulated in some of the markets, and some markets it is regulated.
Right, so I don't think there's any market where it is properly regulated yet, but there are different first movers. And we're going to see, I'm pretty sure, out of the European Union, more regulation. And I mentioned this letter by the ESMA, and I know that the European Union, the European Commission, is actively thinking about this. There were hearings by the Commission about ratings, and there will be guidelines and regulatory guidelines moving forward by the European Commission. And it will probably be about transparency and in terms of methodology, and it will be about more transparency in terms of conflicts of interest, mostly through disclosure. And this will also come in the US. I mean, you have seen the political debate in the US. There's a huge skepticism when it comes to ESG investing in some of the states. And so it's only a question of time until there will be more regulation. I think it's good, not for the reasons that these ESG skeptical people are raising, but because it's more fundamentally such an important sector driving so much capital allocation that we need to carefully understand and think about the incentives, and also need to do some regulation moving forward.
It is scary because the way ESG funds are growing worldwide. Second, in India, okay. Second, first was queries to say, just a minute. In India, we have 10 ESG mutual funds, 2 FOFs and 1 ETFs, and it is growing very fast. To retail investors, what should they look for in an ESG mutual fund?
So this is a good question. And you'll get a skeptical appraisal. And let me preview this by really saying I do believe in ESG investing, and that value can be created. But what I also do see is that a lot of mutual funds have been jumping on the ESG bandwagon, not because they believe in ESG investing, but because they recognize that they can make money. So I have in one of my slides that I show my students a comparison of 2 funds and the top 10 holdings of these 2 funds. And if you compare these 2 funds, actually the top 10 holdings look almost identical. But actually one of the 2 funds is an ESG mutual fund and the other is a standard mutual fund. Right? So the differences are minor. But what is the major difference between the 2 funds? Well, the mutual fund that has the ESG label is 5 times as expensive as the other mutual fund. And I would claim this holds more broadly, that a lot of mutual fund providers have recognized that there's a willingness to pay higher fees for buying these mutual funds that are labeled ESG, while in fact, I would raise lots of questions whether they're actually actively incorporating ESG issues in the proper way. Second answer to your question is, we need to think very carefully about what expectations we have when investing in an ESG mutual fund versus a standard mutual fund. So like I said earlier, if you believe that ESG investing is good because firms with high ESG quality have better carbon footprint, are better prepared for regulation along the environmental or social dimension, then these high ESG quality funds should be less risky. Right? And there's evidence, for example, one of my papers also shows this, that firms that produce a lot of carbon emissions are less risky. Now, if you take that a step further and apply Finance 101, that means that given these properties, covariance properties of these stocks and how these stocks would move in the future if there's a ESG shock, then given the lower risk of these ESG stocks, they should provide a lower return, because they have less risk, and therefore investors holding these stocks demand a lower risk premium. Right? So moving forward, it would be absolutely fine if high ESG funds have a lower performance, not because they're worse, but just because they're less risky. But this is not how these products are usually sold. Right? These products are usually sold along the lines of, if you buy this ESG fund, you're going to get an outperformance. Right? But that's not clear at all. Maybe there's an outperformance, but how can you create an outperformance? Well, if there is an ESG quality that you see, but the market doesn't, and the market gradually learns about this, right? So you invest in stocks that are undervalued because the ESG quality is not perfectly seen, and gradually the market learns, so the stock price adjusts upwards. Yeah, but I don't think this is likely, and I don't think it's likely that the average mutual fund will be able to have that ability. So that's why, in equilibrium in the long run, I think this risk premium argument is going to become dominant, especially if we don't have this continuous shift into mutual funds because of the shifts in preferences. But this is not how usually these products are being sold to investors. Right? And that's, let me move one step further. That's why I'm very concerned that we have an ESG bubble, that we have a lot of greenwashing, that there are lots of parties in the financial markets that enrich themselves because of that ESG bubble, and that this bubble will burst at some point, and then we once again, like after the financial crisis, have a trust problem that the normal investors don't trust the financial sector anymore, this time because of this mis-selling related to ESG and all these conflicts of interest that I predict will emerge moving forward. And that would be a fundamental problem, right? Because if then we see less ESG investing moving forward, we're going to have less of the needed transformation to achieve our climate targets, for example. And so it would really threaten, if there's a loss of trust, the green transformation that we all need. Right? That's why I'm so concerned about that, and that's why my plea is really to challenge the sector and believe in the good parts, but challenge the bad parts. And that's why I said earlier, if we think about ESG ratings, there's the good, there's the bad, and the ugly. So let's keep the good and challenge the bad and the ugly to get this all set up right.
So actually on a question related to what you were just saying, so I was wondering how you actually construct these factors. So if the factors have to do with risk and return, right, then you don't need any special ESG thing because hedge funds will figure that out for themselves, right? So you're just optimizing your portfolio. You have these new risk and return factors that people hadn't thought about before. And now you have them like maybe exposure to climate stress or something. But then the market will deal with them all by itself without any intervention by our part. And if they're not risk and return factors directly, like there's some sort of feel good factor, basically, right? Then it's kind of then it's completely arbitrary. No two investors should have to agree on what the ESG score for a company is, because it depends upon your personal values and how they impact on how the company is operating. So there's really no way. So there's no loss function against which to judge whether or not a factor is correct. So it seems like factors where like really don't need ESG because it's just risk and return and people can do that themselves, or it's not risk and return, but then it's kind of arbitrary.
I think that's a great question, and you're absolutely right. I mean, if we want to explain returns, we need to decompose whether these returns reflect the ESG, the risk related to ESG investing, or whether they reflect these preferences. So we need to separate that. And now, like I said earlier, I would say that certainly some of the returns that we have been seeing in ESG funds are because we have seen the shift in preferences. So more investors being willing to invest in ESG products, so ESG funds, buying up high ESG quality stocks and pushing up the prices. Now, will this continue moving forward? I have question marks. Actually, we may see some reversal. Right. So having said that, in terms of the equilibrium, certainly there are these two factors, preferences and risk considerations. But as I said earlier, I think in the long run, these risk considerations and the understanding that first and foremost ESG matters because it's an investment risk is something that will dominate the kind of risk return patterns in this market. And that's not to say that, for example, if you think of impact investing, that there are some investors that are willing to give up return, risk adjusted also, to achieve certain values. But that's, like I mentioned at the beginning of my talk, that's the 5% or less of the market.
Thank you, Professor. I think everyone here has a question for you. That's what I can understand from the audience around here. And then I wish we would have had you in person here for this session. But maybe we look forward to inviting you in the future down to NISM. It has been a great session. What we understand is ESG is a very noble investment process. But then the scores are still not being reliably measured. The whole process of ESG investing is still evolving, and then maybe the investors are a few years ahead of their time when they are probably putting their money. They need to be aware of the good, bad, and ugly which has been put forward just now. So with these few words, I would like to thank for an excellent session. Thank you very much, Professor Zacharias, and I would like to thank Viral Acharya ji, who actually referred you to us. So thank you very much.
Thank you.